Hey there, welcome. Today we will be diving into the world of real estate and how the European Central Bank's interest rate decisions have shaken things up. We will uncover why sellers are holding back, buyers are playing it safe, and how does this impact the market. Stick around till the end, as we've got some insights on what is happening now and what it means for the future. Let's go. Last year, real estate remained the most distressed sector for 2 consecutive quarters. This means that due to the strain of high borrowing costs and unpredictable economic conditions, real estate investors face risks of missing interest payments, potentially resulting into the property sales at a discount. Here is an example to demonstrate the danger of this distress. Imagine someone bought a house and financed it with a loan starting at a 2% variable interest rate, with a monthly mortgage payment of $1,000. Now, 1 year later, that interest rate, being variable, shoots up to 4%. At the first glance, it doesn't seem like a big deal. 2%, 4%, but in the real life, the change from 2% to 4% is massive. This is because this bump actually doubles their monthly payments from $1,000 to $2,000. See, when the interest rate doubled from 2 to 4, the monthly payment doubled as well from $1,000 to $2,000. This kind of increase can catch someone completely off guard and make it very hard for them to keep up with the monthly payments. Indeed, when looking into purchasing a property, beyond construction quality and location, one must look into the interest rates provided by the banks. And these interest rates are in turn influenced by the interest rates that are established as a part of a global monetary policy by the European Central Bank. These rates in Europe can undergo adjustments as often as every 6 weeks, because this is as often the European Central Bank's representatives meet to review their decisions on the monetary policy. So, quick summary, real estate prices don't just reflect the property values, they are profoundly influenced by the interest rate movements. Why? Because normally to buy a property, you would need a loan to finance it. When borrowing costs are low, buyers feel more comfortable paying higher prices. Lower interest rates mean more manageable monthly mortgage payments, empowering buyers to stretch their budgets. For example, home prices soared during the pandemic when borrowing money was incredibly affordable. On the flip side, high interest rates make buyers more cautious. When borrowing becomes expensive, buyers look for lower prices to offset higher borrowing costs. Simply put, high borrowing costs require additional incentives for buyers to make a purchase, and this comes often in the form of lower property prices. So, what is the current situation? In the last meeting on the 14th of December, ECB decided to keep the most watched interest rate in the Eurozone at 4.5%. In the meantime, in a survey of Financial Times, most economists expect interest rate cuts in the second quarter of 2024. However, despite what many economists predict, it seems that the anticipated interest rate cuts will not happen as soon as expected. This is because the Federal Reserve, Fed, in the USA hinted that the interest rates will not come as swiftly in 2024 as expected. And over here in Europe, we often look overseas to see where the global economy might be going. Another reason is that German inflation soared to its highest level in 3 months by December 2023, primarily due to high energy prices. As the USA hints at this scenario, and a European top economy faces rising inflation, the prospect of interest rate cuts starts to fade away. That said, there is a time lag effect that states that there is a delay of up to 18 months between the interest rate change and its consequences. This suggests that it might take up to 18 months to witness the full effect of the current interest rate level, which, by the way, is even higher than during the 2007-2008 financial crisis. So this means we might have not yet experienced the full severity of the current interest rate level. Right now, the real estate market is frozen due to the rising interest rates since 2022. Sellers refuse to sell at the current price because they prefer to wait out the temporarily unfavorable market conditions, aka high interest rates, while the buyers either cannot buy at the current price because the borrowing costs are so high, or they do not want to buy at the current price as they anticipate the selling pressure to increase. Keeping in mind the situation of distress in the real estate sector, it looks to me that buyers are not wrong. So, keep an eye on those interest rates, stay tuned, stay informed, and take care. Bye.